Hey, what's up guys, welcome back again to another episode. So I want to share something very quick. So this is a very quick one, so this might be a 10-minute video. So clearly last time, the previous short video also we talked about accumulation, manipulation, distribution phase. So the whole point was I tried to show you that there is an accumulation of orders here, and we usually know next that the thing that will follow is manipulation. And manipulation is we will go on the wrong side first before we distribute the price to new heights, right? So what happened here is that when this consolidation happened, initially I thought we were dealing with just this sell side liquidity. That is why I thought this was my dealing range. But when I went to 1 hour, everything kind of changed later. So on 1 hour, I realized that I should have taken these highs from this high to this low as the last dealing range that I was supposed to be considering. That was something that I was supposed to do. Yeah? So in this dealing range, you can see when the price came to 50%, there was a reaction, and in that 50%, there was this fair value gap. So this fair value gap we needed to know. Sorry, I was distracted. So this fair value gap price reacted to this fair value gap. And when you go now back to 15 minutes, it becomes way easier again, because we had this consolidation, then the price had to do the manipulation. So this was the manipulation. I brought this to you before, and you saw it happening. So this was the reason. This was the reason why this price was coming downwards. We said to be a good trader, you need to understand the reasons why prices go into specific places. So I wanted to point out that, yeah, we are coming here, but we have another reason why. Because even after consolidation, the manipulation phase has to have a point of interest to where are we bringing the price. Now, after that, where is the price supposed to go next? Because you also need to know why are we selling to buy, or why are we buying to sell. You need to have just that continuation of thoughts. So sometimes these actions might take shorter time. Sometimes it can happen in one session. Sometimes a phase can take even 5 sessions. You understand? So in this consolidation, it happened in 2 sessions, from Asia to London. Then afterwards, we had a breakout before New York AM. Actually, during New York AM, we made a retracement to a specific point, and then we reversed back. And that is where now our entry came in. Because what we were looking for, we were not looking to trade manipulation phase. We knew manipulation phase was coming. So we wanted to trade the distribution part, because the distribution part is the longer part. It takes even way more sessions. And that is what we want, because we know when we buy low, we can sell high, and make a lot of money. That's the whole point. So we took the first trade. So it went high, made a retracement towards Asia. There was another entry. This entry was supposed to be, you're targeting these highs, because we will take them. So because the entire thing is, when you make a consolidation phase, the power of 3, and there is a reason why this model has always been powerful, and ICT usually rambled about it, because it was really powerful. So when consolidation phase ends, maybe, I don't know how today, if the consolidation phase ends, the whole point is distribute the price way higher, right? And close it somewhere. So for us, we knew this consolidation, when it ends, this high, we have to take it, because even the model, that's the purpose of having accumulation, manipulation, and distribution. So we'll have to take this high, right? By default. So that is why when you take it here, you just relax. it's not gonna come here back again because it has to go higher. So we are having another retracement currently on London. So I'm not thinking I want a bigger retracement. I just want to see some reaction towards this fair value gap. So I know by sure if the price comes to this fair value gap, there will be a reaction. And because the fair value gap is quite big a little bit, I just want just below the fair value gap. In between the fair value gap, the consequent encroachment of the fair value gap, anything below it, that's my interest. So I can have my buy limit from there and my stop loss just below this, because I'm not interested if the price is trying to go lower. If it tries to go lower, that's why you have the stop loss. Now, where is your ideal take profit? Your ideal take profit is first TP1. We are assured to take this high. You see this high? We are assured to take that high, right? So when you take that high, where else maybe are you targeting? This other high, the bigger one, right there. So this is the setup that you probably have in New York, and that's why I wanted to bring this video before it happens. So it will be a short video, so it's just a continuation and explanation of why are we still targeting maybe high highs, or where is our thoughts today, right? So we are continuing this phase plus the market maker buy model. So the market maker buy model, you can maybe even Google more about the market maker buy model, but it I've seen it complementing well with gold structures of late, especially if you see something like this. It really helps. So I want you to see it while it's unfolding, so that you can see if you can see how this has been easy. Sorry, I'm very distracted today, but I had to do it either way. Sorry guys. Yeah, so wait for something like this. But if we go lower below that one, just be patient a little bit so that you can see if we're going to take this low. Because if we do immediately that we do, there will be a heavy rejection, because the entire thing is we are bullish. We're still bullish. Yeah. So, but if we have a heavy retracement, if this stop loss has been hidden, if we hit this stop loss by now, if we hit this stop loss, the next entry should be here, the next one. If you have to re-enter, that is, if you have to scalp or do anything, the next one should be here. If you lose this one, this should hold. That's how we actually know, because as long as you're not taking a full margin, you need to have a risk management structure. If you lose one trade, can you win the next one? Because you have to have a narrative though, and your narrative should be supported in any time by another structure. So you don't just trade from one structure, and that's how you fail, but you still come up. Yeah. So even if I ever lose, I'm always assured that if this didn't hold, I know this will hold, because my model and how I'm trading, I know there is a reaction at every point of liquidity grabs and imbalances. That when I discovered that, I'm like, how do you now fail? If you really know there is a reaction towards this and there is a reaction towards this, and you have some edge with money, that's all you need. You just need to know where price reacts and why does the price react there. So if you know that, you have even a better edge. Like you can grow anything, like literally. We can do this practically and see. We can do that. We can take $100, maybe even to $10,000. Like record it and see all the entries. Where do we take the entries? Why do we take profits in specific places? Why do we take partials somewhere? Even though you're wrong sometimes when you're right, even though you're wrong at a degree. There is a part where in that structure of yours you are right. But to what point? Where does the price react mostly? Every time it reaches a specific place where there's a fair value gap, what's the reaction for the price? What is the reaction of the price when it gets to take some sort of liquidity? Now, when you know that, you can use that even to micro minutes. You can go to smaller minutes and use that to advantage. Because now on 15 minutes, now knowing there is a fair value gap at that level, there is no way I'm going to enter now. I'm just going to wait to see the reaction of the price to that fair value gap. And if I have now to do something to the market, I need to do it when it's at that part, because I have more edge and probability that supports that there is a reaction that coming at this point. But also you need to know, not all areas that works the same. You need to have at least, again, a structure in your head. Like you need to trade off something, or off a backbone of how things work. So this is the same reason why we are trading how we are trading. We are trading from a structure of power of 3, and we've seen how so far the one phase is done, and we are in the second phase, which we are ending the manipulation and now going to the distribution. So that is our model. That's our model. That's our base. And now we know how price react in different places, like fair value gaps, imbalances, those gaps. And we know when it comes to a major structural low or high, there's usually a reaction. So when price goes and eats the previous session's low or the previous session's high, there's always going to be a reaction. That reaction, now that's where we capitalize on making money. And we have to be quick. Sometimes you don't need to wait for someone's signal. You need to just see it, execute, and then come back again and see why you did what you did. If you ever trade without reasons, you are preparing yourself to lose. But if you trade with reasons, back yourself up, see why you're doing things. Even if you lose and you are trying to follow a model, that's okay. You will need just to refine a little bit on how to be more better on that. But I'm trying to show you how simply you can be dependent by yourself. Never think of anyone when you're trading. Maybe you can think of someone who taught you that, but you don't have to depend on anyone at all. That's the whole part of this series that you're doing. So what you're doing is that you see them by yourselves. You decide by yourself. You identify things by yourself. You see them, you see the reaction, you feel them. Sometimes you get involved, because the more you're involved, the more also you feel like you understand how the thing is moving. So don't expect anyone to always feed you. And that's what I usually try to stay away from. I want you to just have a reasoning that is so simplified that you see, the market has only two things to be done. You can either buy or sell. That's all. So don't complicate how to do buy and sell. All I'm trying to train you is to find a reason on whichever you choose. So understand the reasons why price go, and where is it coming from, and where is it going to. Why are we buying to sell, and why are we selling to buy? Because we understand the price doesn't move in a straight line. It always has highs and lows. So we need to predict the next high and low. That's all we have to do. But now we need to do it in a systematic way, that it has to follow a specific procedure first, so that it's the right conditions for us. If it doesn't, we are willing to wait, because also what we are doing is we are preserving our capital. It's as simple as that. So, ladies and gentlemen, when I showed you this structure, I didn't know I'm going to make money. I made money. Maybe somebody lost money. Why? They need to understand that there is when all these things make sense to you, you will see how stupidly simple everything is. Like you will wonder why even you took all this time. Like, it's so stupidly simple. When you see it first, you try it the second time, fear goes away. Fear goes away, and you just buy and just leave it. Just have your stop loss and your TP. Just have to watch it. You've seen countless times me making these videos. Why? Because it's the same thing repeatedly. The whole point is just need to understand your capital size, so that you understand you understand lot sizes that you're going to have. But yeah, it's as simple as that. If your account can manage something, then do it. So all you have to do, guys, also back yourself with a good broker. That one, I'm not selling any broker, by the way. I have no affiliation, but I'm telling you something. Also, when it comes to trading, they are good trade. There are people who get way more money just because they have a specific kind of trader, like broker. Yeah. There are brokers who here they're in another business, so you don't even have better margin levels. Sometimes you might see a position that you want to like utilize all you have and all you can get. Some brokers, they're like, no, your money is not enough to take way more positions, and you're winning. You're winning so much, but your margin levels are freaking low. So those ones, if you have big accounts, yes, there's no big difference. But if you're doing anything less than 1,000, you really need a good broker with all the leverage that you can get. At less than $1,000, man, you need a big leverage, because sometimes you might see something that can change your life, but you have $1,000, so you don't expect to make 200K on 100 pips rally with $1,000. With any math, that's not possible. But with a big leverage, even with $100, you can do that, because they give you a growing margin that is freaking huge. So if you really know that there is a reaction on a fair value gap, or there is a huge reaction that is going to happen when a specific sell side or buy side liquidity is taken, and you only have $100, and this is one time that you're sure, there sometimes you wish you had $10,000. But now, in a leverage of 1:2,000, you're not getting anywhere. But with 1:1 unlimited and some brokers that you can actually withdraw, then do it. Take 1:1 unlimited. You will have a very big margin. So you can have like 0.01, and now you can have as many positions as you can. That's one of the reasons why you will see most people with a small account, but they are doing 0.01. It's if you go higher, the margin will not be enough, so you have to take the smallest. They usually accept it, so you can take as many as you want because you have 1:1 unlimited. Yeah, that's how people actually make, like, flip big small account to big massive account. You cannot do that with 1:500, 1:, because 1:1,000 probably with a balance of $0.9, you cannot take a position. But with some 1:1 unlimited, I've seen where most people, they can take even 6 positions with 0.9 account balance. And then when that account becomes like $2, it can take even like extra 10 positions. In some accounts you can't do that, and it's not because that there is something happening. No, you didn't check what you're looking for. If you're a scalper, you want a small account to grow, look for bigger margins. And you have to test it out so that it can be actually a good margin. Like you press, it goes, press again. You will have a threshold, yes. But if you don't retrace and still go forward, the margin increases. You can take more and you can exit and you can still make money. So that's why you see they can have like a $2 account, make it to $10 in one go. You exit, now you start with a $10 again. Now you have way more margin than when you started. You take again to $20, you exit, you take it again now to 20, to like now 80, 100, you exit now. There you have a very massive, as long as you're less than 1,000, you still get the unlimited one. So you can now take from a 200, you can imagine how much you can make. 10,000 is something easier to do that. And you've seen people do that, but there is that part that you've never understood. How is that even possible? No, they've known there's a specific level when you get, there's a reaction you see, and you use that reaction on your like on your advantage. So let me give you an instant. If now I'm waiting to see New York open, let's say for example New York opens and goes higher, but it doesn't take this low, it comes again, takes that low at 8:30 when now more volume is in the market. Most probably this thing will start retracing way higher, or there's a chance that it will drop faster. Let's say it drops faster. I haven't made any decision, like I have maybe $50. It retraces, and then I see there is a sort of slowing down after it takes this low. Immediately you see slowing down. At that part, you expect a reaction. Why? First of all, we've taken Asian low. That's one. Two, we came to a big gap that was in that region, and now it has slowed down. You only have a few seconds to make a choice of what to do, and do it or don't. Because in that instant, you expected this reaction to happen. It didn't. It went way further to this low, Asian low, the previous session's low, where you expect a reaction to actually happen. It coincides with another place that you might expect a reaction if a price comes to that level. And the price didn't have any retracement in between. It's one huge stretch. In most cases, that price will be brought back again to the open-end price. In most cases. So, this is where now you have a split second to make a choice. To go now all full margin and risk it all. And if it goes to your advantage, if it gets to somewhere back to, let's say, this fair value gap where, again, even if we rush past a fair value gap, sometimes when we come back again to it, we might have a possible reaction. So if you go full margin here, you need to take something. You need to pay the trader. Take something out here. So far, maybe you'll have doubled your account, and now you've left with like now half of or a quarter of your trades running. Now, those ones are free trades. All you have now to do is, if this was your entry right here, all you have to do is secure everything and make it a free trade completely. So if you now expect that this trade is supposed to have a continuation, you forget about this trade. That's an investment. Your initial deposit was, you achieved it and you withdrew it. So this is a free account that it's like free money you're given, and you can monitor and take it out whenever you want. But even if you lose, there is nothing that you're losing. So it's a free account. It's a free trade. So you leave it. Until the structure is done. So that's how you can either get in fast, heavy, get out, make sure that what you took it out now is like your stop loss for the next, for the entire, the remaining one. That's how I think sometimes when it comes to making decisions fast, and how I do that. Sometimes I'm like, it's not where I want to be. I want to trade, so I don't just press buttons. So what I do sometimes is I set traps, the buy limits. So if I know I want to see a reaction right here, I'll have maybe like a couple of positions for buy limit. Maybe one in the beginning of that the beginning of those bodies, others on the tip. Maybe I'll go lower with another one. So I'll spread out like 4 positions, so that sometimes it can just tap one and never come back again. So that the first one usually it's like the risk taker one. The next one is usually below it, so that if you're going to retrace deeper, at least let me take a chance to take it lower, so that I don't maximize on, you know, the losses. I want to minimize my losses as much as possible. So I usually know when I see a reaction and I want, you see, there's places you have to see a reaction. That's where now my entry zone is usually, because somewhere like this is where most people have their stop losses. So their stop losses is my entry. Yeah, I usually buy their stop losses, because I know the price usually, the price can come and just take their stop losses and revert. So I want to enter and now, you know, follow the price. So ladies and gentlemen, that was it. So let me send this video link to you guys so that you can watch, maybe take something out of it. See you in the next one.